Hi, my name is Phil Elrod. Welcome to Chapter 2 in our series of videos describing my new ebook, See the Music of the Market. In this video, we're going to describe how we see the trade as we watch the music of the market. The first thing we need to do is define a minimally acceptable trade, because we never want to take a trade that does not offer a guaranteed minimal amount of potential profit for the inherent risk that we're accepting by taking that trade. When trading, we like to think of risk, profit, and stop loss in terms of ticks rather than dollars. A tick is one trade, and a tick is also the minimum amount of dollars that is allowed to trade in the particular market we're trading. So we can always convert ticks to dollars very, very easily. But for determining our minimum trade, we want to use ticks. As an example, we're going to show you how we would calculate the minimum trade for the U.S. bond market, which is one of our favorite markets to trade. First of all, we use a visual analysis system for entering a trade, and if that visual analysis pattern is broken immediately after we enter the trade, we get out rather quickly. So we have a very low tolerance for risk in this market, and our stop loss is usually set at 4 ticks. It costs 1 tick to get into a market, and we will accept 2 to 3 ticks against us, so we'll average about 4 ticks as our stop loss. Well, we never like to trade unless we can make at least double our risk. So therefore, if our risk is going to be 4 ticks, then our minimum profit has to be 8 ticks. In trading, it's very difficult to capture more than 80% of any market, so in order to get 8 ticks of profit, we have to have a move that is potentially going to offer a minimum of 10 ticks. Once we know what the minimum move to make a potentially profitable trade actually is, we're ready to move to the chart and project that value onto the right edge of the chart, which we call the trading edge. This is where we're constantly watching for those oscillations that provide trading opportunities. What we're watching for is a point at which 2 horizontal lines are sufficiently far apart as to accommodate our minimal trade value. Those horizontal lines, we call them support and resistance values, or SRVs for short, are one of the most important parts of our trading methodology. We're going to be discussing them in great detail in our next video, but for now, just remember that we're seeking a trade that will start at one SRV and end at another SRV, and the distance between those 2 SRVs must be at least 10 ticks in this case, which will justify our minimum trade requirements for the risk we're taking. As price approaches an SRV, one of 3 things can happen. It can either hit that SRV in reverse direction, it can break through the SRV and keep going in the same direction, or it can stall for a period of time in and around the SRV. Actually, 2 of these scenarios provide trading opportunities, and even the third one can eventually lead to a potential trade. This method of trading is based on visual analysis, which once learned, the analysis and the final decision of to trade or not to trade can be made almost instantaneously. You can learn all about seeing the music of the market and our method of trading we call trading between the lines by getting our ebook, See the Music of the Market. See the Music of the Market is available currently at a discount from tradingbetweenthelines.com. Once again, that website is tradingbetweenthelines.com. And while you're there, take a look at our blog. We're always discussing things that will be of potential interest to short-term traders. Thanks for watching this video. And don't miss Chapter 3, in which we discuss the technical tools we use, and Chapter 4, in which we discuss the logic we use to select the most potentially profitable trade. In the meantime, good luck in your trading.